Hi, my name is Sigmund, and welcome to another session with us on our sustainability series. And in this series, we'll be talking about integrated reporting. I hope you have watched the other sessions which have already passed regarding issues of sustainability. In this session, we're focusing on integrated reporting. And to better understand integrated reporting, there is a way of thinking that will inform us to better appreciate issues of integrated reporting. So, what is this thinking? We normally refer to this as integrated thinking. So, what is integrated thinking? Now, traditional thinking, which is the usual norm of most companies, have the understanding that corporate performance, exactly the performance of an entity, normally concentrates mostly on the financial and the manufactured capital of the entity. Most times it neglects the people capital, that is the human beings and the capital they create, for example, intellectual, social, and relational capital. Is that okay? Or even the wider natural capital within which all capitals sit. So most corporate performance concentrate on financial and manufactured capital. What this means is that companies, in preparing their report, focus only on financial issues or the capitals that most of the time they create within the business. And the aim of integrated reporting is to change the narrative to now consider a more holistic and cohesive approach to corporate reporting where there's a clear link or the link between financial and non-financial performance can be clearly explained in your report. So basically, the integrated report is built on integrated thinking where financial and non-financial outcomes, which are mostly intrinsically linked, are clearly reported. Because the challenge is that most companies will prepare a financial statement separately and then also prepare a separate sustainability report. But the question is that the two, there should be some linkage. And that linkage is where integrated thinking comes in. And once you appreciate integrated thinking, then obviously you can appreciate issues on integrated reporting. To further explain, integrated thinking appreciates that usually there's a constant flow between capitals as they increase or decrease. For example, if you are providing training to employees, that would definitely decrease your financial capital, which is mostly the focus of most of our corporate performance. But once we spend money to train employees, the look of it is that there's a reduction in our financial capital without not looking at the other aspect of capital. Is that clear? But obviously, if the employee is trained, there will be an increase in human capital. Clearly, there's some appreciation in terms of capital at one end and a reduction at the other end. And that is what integrated thinking is all about. So companies must actually look at the relationship between the various capitals. There will definitely be some decrease in one area. There will definitely be an increase in another area. And obviously, understanding that relationship is very important when it comes to integrated thinking, which is the basis for integrated reporting. So integrated thinking involves companies considering the relationship between their operation, that is the operation and the activities they have, and the resources. Mostly that's what we refer to as capital, and how their activities or operations will either affect those capitals that they use or how the entity will affect the capitals. Exactly. So basically, if you really want to understand integrated thinking, it refers to most of the resources organizations use as capitals, and we are going to look at the various capitals that inform integrated thinking. Let's look at those capitals quickly. So the first one is financial capital, which is the popular one that you may be very familiar with, which is the pool of funds available to the organization, which include debts, equity, finance, and mostly available for use in the production of goods and services. Then we have the manufactured capital, which normally is created by man, involving equipment, machinery, building, technology, infrastructure, all that are normally used in the production of goods and services. And most times, our usual corporate reporting usually consider most of these capitals. That is essentially the capitals that our current financial statement normally consider. But without not considering the people capital, as well as the natural capital, most financial reports do not consider these other relevant capitals. And that is the aim of integrated reporting, to bring to bear the relationship between all these capitals and as well as the entities' activities as well as their operation. So, for example, we have also the intellectual capital, which is about the organizational knowledge base involving intangible assets, intellectual property such as patent, license, systems and procedures that a company have. We also have the human capital, which involves employees' capability, their knowledge, their skills and experience to the point where they are motivated. Is that okay? Then we also have the social and the relationship capital, which considers the relationship within an organization and between the organization and its external stakeholders, the network the company has, and how those information or those relationships help the entity to enhance their well-being. Exactly. So we also have the natural capital, which are mainly made up of the renewable and non-renewable resources, the processes that provide goods and services to support the prosperity of an organization, include air, water, land, mineral resources, forests, as well as the ecosystem of the country. So all these capitals, exactly, understanding the relationships within this capital and how this relationship can affect an entity is what integrated reporting is all about. And understanding this relationship and being able to report on them is what integrated reporting is all about. Because in the past, most corporate performance are always looked at from either the financial capital as well as the manufactured capital, without not considering all the relevant other capitals and the relationship thereof between them. I believe I'm making sense. So basically, that is the thinking that informs what we call integrated reporting. The aim is to ensure that relationships between all these capitals are well explained and evaluated in order to consider the company's performance. Some capitals may increase, some may decrease, but the point is that once we are able to understand and appreciate the changes in these capitals, we can then have a more holistic report in terms of financial performance from a more holistic perspective. I believe it's clear. So that is integrated reporting. We'll be looking at the next session where we'll look at the value creation process, which is very important for us to better understand integrated reporting. Then beyond that, we'll look at the integrated reporting framework, which is the final issues we'll be looking at in our various sessions on the sustainability series. So thank you for watching this video. I would plead with you to immediately like this page and share with a friend. And if you are interested in our programs, our training programs, our professional qualification program, you can download our mobile application on Android, iOS, as well as Microsoft Store, and immediately have access to our program. Thank you so much. My name is Sigmund, and I'll see you in the next session. Bye-bye.